Hey there, awesome accounting student. Mark Franke here. In this video, we're going to talk about Chapter 3, adjusting journal entries and the concept of deferrals and accruals. So the first step is just to talk about the theory behind why we need to make adjustments. So far, we have recorded transactions into the accounting equation, and that's great. However, at the end of a month, at the end of a quarter, at the end of the year, there are certain accounts that need to be adjusted. These are accounts that, like an asset that has maybe been partially used up, or we may need to provide or record a liability for something that we have received that we haven't recorded yet. But everything is based on these two concepts of deferral and accrual. Deferral means to push into the future, and accrual means to bring it into the present. Okay, so if you defer something, it means you're pushing it out. If you accrue something, it means you're pulling it in. So if you just think in those terms, and there are things that you've learned in Accounting 100 and so far in this class that relate to these two words, deferral and accrual, but you probably didn't think of them in those terms or in these words. So we're talking really about when something is earned, if it's revenue, or incurred, if it's an expense, versus when we receive the money or when we pay the money. So oftentimes we receive money in advance. We haven't done the work. The Lakers, the Rolling Stones, airlines, insurance. These are all companies or situations where we receive money in advance. If we were the Lakers, they're selling, well, right now things are not good because of the COVID, but when in a normal situation, they sell season tickets way in advance. They get all of this money, millions of dollars in advance, and they have not played any games yet. Or in the case of the Rolling Stones, they have a concert. It's sometime in the future, they sell the tickets, they get all this money in. They haven't done anything until they actually do the concert. They haven't earned that revenue. So whenever we receive money in advance of when we're actually going to do the work or provide the service or ship the goods, we have an account, a liability account called unearned revenue. Now on the other side of it, if we ever pay money in advance for services or goods that we're going to receive in the future, here is an asset. If we buy Laker tickets so we can take our customers to a Laker game, and we send money to the Lakers way in advance, that's a prepaid, that's an asset. Or in traditional things, we prepay insurance because insurance companies won't insure you unless you pay them in advance. Or we have prepaid rent. Maybe we pay the rent in advance. So that is an asset, and we call it a prepaid expense. On the other side, when we're talking about an accrual, this is a situation where we're going to receive money in the future. We've already done the work. That's really, really important, because when we talk about the earnings process in accounting, it means we have done the work. Our customer hasn't paid us yet, but we've already done everything we were supposed to do to get that money. It's just we sent them an invoice and they haven't paid it yet. Hopefully they will. But the point is, we've already done the work. So now we can record an asset that we call accounts receivable, money that we're going to receive in the future from our customers. On the liability side is where we're going to pay in the future. We contract with somebody. We say, hey, computer programmer, we need you to come in and program our computers, send us a bill, and we'll pay it. or there's lots of things, vendors that do work for us or ship goods on net 30 terms, and we tell them, yeah, come on in and do the work, whatever it is that we're contracting to do, and send us an invoice and we'll pay you in 30 days. So in that case, we've already received the benefit. The vendor has already provided us with whatever work that we have contracted for them to do. So we have a liability. We record a liability and we call it accounts payable. Okay, so at some point in the future, we have to make adjustments for these. As these assets become an expense for something we have deferred, we prepaid insurance, we prepaid the rent, at some point, we're going to actually receive the benefit of that insurance, and then we have to move it from this asset to an expense. If we receive money in advance, at some point, the Lakers are going to play the games. And then it's no longer a liability. They've earned the revenue. They can move it out of this liability into a revenue account. So unearned revenue is a liability. That's a credit. Revenue is a credit. We're literally moving that credit out of unearned revenue and into revenue. Assets are debits. Expenses are debits. Prepaid expenses are a debit to start with, and then we move it to a debit to expense as the asset gets used up. So let's get started. This is problem 3-2B. We're going to make some journal entries. So this is in your book on page 134. 134. So if you want to pause the video and set up a journal with the heading Natsu Company, we'll get started. Okay, so transaction A says the office supplies account started the fiscal year with $600 balance. During the fiscal year, the company purchased supplies for $45.70, which added to the office supplies account. The supplies available at October 31 totaled $800. All right, so I'm going to prepare a schedule before I do my journal entry. And all of these are dated as of the end of the month. So we're going to put 10/31/2020. Actually, I guess I'm using 19. Okay, that's fine. And this is going to be transaction A. I don't know what the journal entry is yet, although I do know it's going to be a debit to supplies expense and a credit to supplies. Supplies is going to go down, and we're going to record this expense. And we'll just say to record supplies used in 2019. Every journal entry needs to have some sort of a description. And in this case, we have to prepare a schedule. So we can do it right in the journal. This is the best place to put it. It's a permanent record of what we've done. So I'm going to start with the beginning balance in the supplies account, $600. We purchased during the year $45.70, which means we have supplies available of $51.70. However, we didn't use all of them because at the end we went and counted our supplies. So those are the supplies we didn't use. We'll call that supplies on hand. How do we know we didn't use them? We still got them. So our adjustment for supplies used is going to be the $51.70 minus the $800, or $43.70. So we debit supplies, expense, and we'll credit supplies. Notice the format. Anytime you have to prepare a schedule, put it in the journal. Every one of these journal entries is going to be as of the end of the month. B, an analysis of the company's insurance policies provided the following facts. So we've got 3 policies, A, B, and C, and we're going to prepare a schedule down below. I'm going to pause the video and I'm going to set it up and then explain what I've done. Okay, so I've prepared a schedule from the information provided in the textbook. We have 3 policies, A, B, and C. We start with the cost of the policy, divide it by the number of months covered by the policy. Now, policy number A, well, I guess, yeah, A was around at the beginning of the year, but it was a 24-month policy, so we still had more to expense during the current year. And then B and C were bought during this year, but we didn't have them for the whole year. So the first step is to calculate what the monthly expense is, and then multiply it times the number of months that have expired, which means policy A is half done. So we're going to write off $3,000 of that policy. We have expensed 7 months of policy B and 3 months of policy C. We add those up, we get a total expired insurance. Again, this is insurance that has been gone, that we've used up. $47.30, debit insurance expense and credit prepaid insurance. Entry C. Again, 1031. In this case, they've given us the fact that they have 4 employees that earn a total of $1,000. They're paid Monday for the previous week, and the last day of the month, December 31, is a Monday, so we're going to accrue 1 day of wages, because that's how much wages have not been paid but then employees have earned at the end of the month. Remember, we're thinking at midnight on the 31st of October, how much do we owe our employees? We're not going to pay them right now because we'll pay them the next Monday, but we need to accrue this because this is in the month of October, and we don't want that expense to be in the month of November because that would be in the wrong month. So we're going to debit wages expense and credit wages payable, $1,000. And this is to accrue wages for 1 day or something like that. Transaction or journal entry or adjusting entry D says that we have a building. We paid $175,000 for it. It has a $40,000 salvage value and a 25-year life. They've given us the amount of annual depreciation, but let's go ahead and calculate it. All right, I'm going to stop the video. I'm going to prepare the schedule, and I'll be right back. This is a standard depreciation, straight line depreciation calculation and journal entry. This should be familiar to you from your Accounting 100 class. This is how literally 95% of the assets in the world are depreciated using this exact formula. If you don't know this formula, spend some time and look at it and make sure you know how to do the calculation. We start with the cost, which is $175,000. We subtract the estimated salvage value. Estimated salvage value is what we think it's going to be worth in 25 years. We don't know for sure. It's an estimate, but that's okay because we think that the building is going to depreciate $135,000 over that 25-year life. The life in months, 25 years times 12 months is 300 months. So our monthly depreciation is $450. This year, 2019, we're going to depreciate 12 months, so our adjustment amount is $5,400. Debit depreciation expense for the building, $5,400. Credit accumulated depreciation for the building, $5,400. Again, they gave you that number, and we will do a lot more of these calculations in the fixed asset chapter later on in the semester, but it can't hurt to review this now. Transaction E, or adjustment E, says that the company does not occupy the entire building, so it rented a space to a tenant at $1,000 a month. They paid the rent on September 1st. However, October hasn't been paid. So we need to accrue for the rent that we will receive in the future from this tenant. This is transaction E. We're going to debit accounts receivable. We could create an account called rent receivable, but accounts receivable is fine. Accounts receivable is a debit, and then rental income. We are recording the income because we've now earned this rent from our tenant. We just haven't been paid yet. To accrue rent to be received, something like that. And then transaction F is also because we have a tenant, but in this case, the tenant paid 5 months rent in advance. So that rent was paid on September 1st, and it's now the end of October, so we have 2 months worth of rent that has now been earned. I'm going to stop the video, I'll do the calculations, and I'll be right back. So this is the journal entry to record the rental that was earned. We got $725 per month in advance back on September 1st, but now 2 months have now been earned, the month of September and the month of October. So we multiply that times 2, we get $1,450, we debit unearned rent. Unearned rent is a liability, it's going down. Why? Because we've now earned the rent, at least part of what they paid us, 2 months worth, and we're going to credit rental income. Okay, so that's good for this video. Practice, practice, practice. This is all about deferrals and accruals, Chapter 3. I'll see you again next time. Bye-bye.